Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at 27.50, hoping that it would go down so that he could buy it back at 22.50. If he could buy it at 22.50 and sell it at 27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price if they have extrinsic value. Now the prices of the options, these are called in-the-money options. The in-the-money options have some component of what they call extrinsic value and some component of intrinsic value. And the way you can determine intrinsic and extrinsic value is simply by taking the strike price of the option. In this case, we're taking a look at the May 20 calls, and they're priced at $7.40. On these 20 calls, if you add the strike price to the price of the call, you get $27.40. At the mid price, you're probably talking about closer to $27.25, which is exactly the price of a current stock. So you could say that this call option has no intrinsic value. In fact, if we look under extrinsic value, you can see that it is actually zero.